Today I'm going to take you through my thinking on creating a hybrid DIY annuity or reverse mortgage using the equity in my house by getting a cash out loan at 3% interest rate for 30 years. So this is a hypothetical situation that I'm going to be using Portfolio Analyzer, a tool, an online tool, and that I'm not a financial advisor and I don't have any background as a financial advisor, so you probably need to check this out further with somebody who is a professional. But what I'm going to do is get a home loan for a hypothetical amount of $100,000, and what we're going to do is bring up the amortization table here. So this is $421 in payments using this mortgage, and you can see that we're going to be paying down at least $171 in principal each month. So we're going to have to pay roughly $5,060 a year for this, but we are going to set up an automatic withdrawal from a Vanguard account. And so we're going to create an account at Vanguard and create a 0.5% withdrawal per month to be able to fund our checking account where we're making the loan payment. We're going to be using the Vanguard Wellesley Income Fund. Now it has investor shares and it also has Admiral shares. The investor shares history dates back to 1970, so we have a long amount of history associated with that. Not that history will produce the same results, but they generally do have the same asset allocation. We're talking about here is a 40% stock and a 60% bond portfolio. They have an Admiral shares fund that has lower expense ratio. However, it has the same exact mixture, but its inception date is a lot, it hasn't been around for as long. It just has the attribute of a better expense ratio. So let's look at the Admiral Fund now, or the Investors Fund, and analyze a portfolio of $100,000, 6% fixed withdrawal over time. We're going to look at the summary view now, where it's going to show hypothetically if we would have jumped in back in 1984 and gone all the way to present, that we would have taken out that our 6% or 6 per year or per month, and we would have still had all this growth in the fund. But I think we could look back at this period, which I think most of us remember, 2009 here, we lost quite a bit of money. And so if we were to hypothetically invest and take our mortgage out in 2007 and then we had to live through 2009, how would that look? So let's take a look at that. First, what I'd like to take a look at the annual returns over time, just so you can get a feel for how powerful that 6% is. Just taking 6% of the fund out each year. Wow, you can see that 6% really has increased. It went from us getting 6,000 to 7,000 to 10,000 to 17,000. Wow, what a big change in the balance, the cash flow. And it also, as we looked at, the balance ended up pretty high. So let's though go back and look at what it looked like if we were to made an investment in 2007. Okay, so here's 2007 to 2021. We kept the withdrawal rate the same, and we'll look at the portfolio. Okay, so you can see here we got $100,000 we started, but then we ended up with 76. Now this is after taking some money out of the fund too for a couple of years. It's a bad case, 28% decline, which may be the worst case we can expect. I don't know, right? Let's also take a look now at the annual returns. And you can see that we're able still to meet our mortgage payment here in 2009. We had a mortgage payment we needed to we have to make with principal and interest, which is that $5,000. So we're still able to make that, and then we were still able to have a higher cash flow. And again, one of the other benefits are we have cash that if we have long-term care expenses or something we need to pay for, we have ready cash at a very reasonable 3% rate. So I think that people who may want, and certainly I've been thinking about this way, to do this investment. I've got a limited life expectancy. It's less than 25 years based on the Social Security table here that I'm using, right? So I've got I got 20 years left to live on this based on this table. My home equity is relatively high, 1/3 of my net assets. I'm higher than 1/3 of my net assets. I don't have long-term care insurance, but this is kind of my backup plan, I think, to have money for long-term care and at a very reasonable rate right now. I also don't know, there's certain cash flows that I'm not uncertain. Maybe my future medical expenses will be high. I don't know. Some people have property tax that will go up over time, and they want to hedge against high inflation costs. And I think probably most important, they might want to use that money to do something fun with. And I don't think it's that big of a deal. I'm willing to take the risk. Anyway, I hope that you found this video interesting. Please like or share this video with your friends, and